$847 billion. That's how much Chinese banks just moved into dollar-denominated assets in 8 months. Not yuan, not gold, dollars. Inside a financial system Washington spent decades convincing the world only it could control. And the response from the Federal Reserve wasn't a press conference. It was silence, followed by regulatory maneuvers most Americans will never hear about, but will feel in their mortgage rates, their savings accounts, and their retirement funds within 18 months. This channel operates without corporate funding, without government backing, and without editorial pressure telling us which parts of the story to leave out. If the kind of analysis that connects financial maneuvers in Beijing to your bank account in America matters to you, hit subscribe and turn on notifications. Because what's happening right now in global banking is not making headlines, but it's rewriting the rules of who controls the dollar, and you need to understand it before the consequences show up in your wallet. Let me show you exactly what happened, and more importantly, what it means. Between January and August of this year, 4 of China's largest state-owned banks, Industrial and Commercial Bank of China, China Construction Bank, Bank of China, and Agricultural Bank of China, collectively increased their holdings of U.S. dollar-denominated bonds, structured products, and credit instruments by $847 billion. That's an increase of 34% in dollar exposure in 8 months. These aren't private investment firms making speculative bets. These are institutions that answer directly to the Chinese Communist Party's Central Financial Commission. The official explanation from Beijing was straightforward: diversification of foreign exchange reserves and risk management in a volatile global economy. Standard central banking language, the kind of statement that gets filed away and forgotten, except for one detail that doesn't fit the official story. During this same 8-month period, China's official foreign exchange reserves, the publicly reported number, dropped by 81 billion and CSP insured billion. So while the disclosed reserves were falling, state bank dollar holdings were surging by nearly $1 trillion. That's not diversification. That's something else entirely. The Federal Reserve's public response came in the form of a single paragraph buried in the August Financial Stability Report. It acknowledged increased participation by foreign state-owned financial institutions in U.S. Treasury and corporate bond markets. No alarm, no concern, just acknowledgement. But 3 weeks later, the Office of the Comptroller of the Currency, the agency that regulates national banks, issued updated guidance on foreign bank branch capital requirements in the United States. The timing wasn't coincidental. The guidance introduced new reporting thresholds specifically targeting institutions with parent banks domiciled in countries designated as strategic competitors. Only one country currently holds that designation in Treasury Department documents: the People's Republic of China. Here's what the Pentagon is not saying plainly, and here's what the financial press is tiptoeing around. What China is doing is building redundancy into dollar access, not to abandon the dollar, to make sure it can't be locked out of dollar systems the way Russia was locked out in 2022. When the United States and European Union froze Russia's central bank reserves and cut major Russian banks from SWIFT, the global financial messaging system, it demonstrated something every country with significant dollar exposure immediately understood. The dollar is not just a currency, it's a weapon. And the country that issues it can deny you access whenever strategic interest overrides financial convention. China watched that closely, very closely. Now here's the technical mechanism most coverage is missing. When Chinese state banks buy dollar-denominated bonds, they're not just holding dollars. They're embedding themselves inside the infrastructure of dollar liquidity. Those bonds can be used as collateral in repurchase agreement markets, the overnight lending system that keeps global banks functional. They can be pledged in derivative transactions. They create pathways for dollar access that don't run through correspondent banking relationships the Treasury Department can sever with a phone call. The strategy is elegant. If your dollar holdings sit in accounts at the Federal Reserve Bank of New York, they can be frozen. If your dollar holdings are distributed across bond positions held through Luxembourg subsidiaries, Cayman vehicles, and Singapore branches, freezing them requires coordinating legal action across multiple jurisdictions with different political pressures. It's not impossible, but it's slow, and in financial warfare, speed is survival. The response from Washington is unfolding in layers. The public layer is regulatory adjustment. The private layer, the one most Americans will never see, is systematic pressure on the institutions that facilitate this kind of offshore dollar access. Let me show you the math that explains why this matters more than almost any other financial story happening right now. China holds approximately $3 2 trillion in foreign exchange reserves. That's the official number. Of that, roughly 850 billion is in U.S. Treasury securities, according to Treasury Department data. But that number has been falling for 3 years. It's down from a peak of $1, 3 trillion in 2013. So where did the $1 trillion go? Some went into gold. China has been adding approximately 30 tons of gold per month to central bank reserves for 2 years straight. Some went into infrastructure projects under Belt and Road Initiative financing, but a significant portion, the part we're discussing, went into dollar assets held not by the People's Bank of China, but by Chinese state commercial banks operating through offshore branches. Here's the asymmetry that makes this a problem Washington cannot ignore. The United States issues dollars. It controls the Federal Reserve. It regulates primary dealers in treasury markets, but it does not control how dollars move through the Eurodollar system, the offshore dollar market that exists outside U.S. jurisdiction. That market is estimated at 57 trillion in total claims. It's larger than the U.S. banking system, and it operates with minimal direct oversight from American regulators. When Chinese banks accumulate dollar assets offshore, they're tapping into that system, and the more embedded they become in that infrastructure, the harder it is for the U.S. to weaponize the dollar against China without causing collateral damage to the entire system. Now here's the cost comparison that shows you why this is unsustainable from a U.S. strategic standpoint. Every time a foreign institution builds redundancy into dollar access, it weakens the effectiveness of financial sanctions as a tool of statecraft. The United States spent 80 years building a financial architecture where the dollar was the dominant settlement currency, and New York was the unavoidable clearinghouse. That architecture gave Washington power to isolate adversaries, Iran, North Korea, Russia, without firing a shot. But that power depended on a specific condition. There was no alternative. If you wanted to do international business, you needed dollars. And if you needed dollars, you needed relationships with institutions the U.S. could regulate or pressure. China is not building an alternative to the dollar. Not yet. What it's building is redundancy within the dollar system, a way to access dollars even if the front door gets locked. And every $1 billion of offshore dollar assets Chinese banks accumulate is another percentage point of reduced American leverage. The U.S. response cost is measured in a different currency, control. To counter what China is doing, the Treasury Department and Federal Reserve have 3 options. None of them are good. Option 1, expand the jurisdiction of U.S. financial regulation to cover offshore dollar transactions. Legally complex, politically difficult, and likely to push dollar users toward euro or yuan, alternatives faster than China could do on its own. Option 2, pressure allied jurisdictions, Luxembourg, Singapore, the United Kingdom, to impose stricter controls on Chinese bank operations within their territories. Possible. But those jurisdictions benefit enormously from being hubs in the offshore dollar market. Asking them to shut Chinese banks out is asking them to sacrifice revenue and relevance. Option 3, accept that the dollar's role as a financial weapon is diminishing and focus instead on maintaining its role as a transaction currency. That's a strategic retreat, and it's the option no one in Washington wants to say out loud. So what's actually happening is a 4th option, slow regulatory strangulation, increase compliance costs, expand reporting requirements, introduce capital charges that make offshore dollar operations less profitable, death by 1,000 regulatory cuts. But here's the problem with that approach. It's slow, and China is moving faster. Now pull back from the immediate banking maneuver and look at the geopolitical chessboard this sits on. China is not doing this in isolation. Russia is watching. Saudi Arabia is watching. The United Arab Emirates is watching. Every country that holds significant dollar reserves and maintains complex relationships with both Washington and Beijing is studying this moment because it reveals something about the future structure of global finance. What China is demonstrating is that you can be inside the dollar system and still build resilience against dollar weaponization. You don't need to create a competitor currency. You need operational redundancy. Russia tried to build alternatives after 2014 when the first sanctions hit over Crimea. It created the System for Transfer of Financial Messages, SPFS, a domestic alternative to SWIFT. It tried to increase yuan and euro reserves, but when the full sanctions came in 2022, none of that mattered. Russia's central bank reserves were frozen, its major banks were cut off, and its ability to conduct international trade collapsed overnight. China looked at that outcome and drew a conclusion: alternatives are not enough. You need to be so embedded in the existing system that cutting you out causes systemic risk the West is unwilling to accept. The technical term for this strategy is too interconnected to sanction, and the dollar bond purchases are one piece of a broader effort. Here's another piece most analysis is missing. At the same time, Chinese banks were increasing dollar bond holdings, Chinese corporations were increasing their issuance of dollar-denominated corporate debt. In the first half of this year, Chinese companies issued $184 billion in dollar bonds. That's up 41% from the same period last year. Why does that matter? Because every dollar bond issued by a Chinese company is a liability that has to be serviced in dollars. And servicing those bonds requires access to dollar liquidity. If the U.S. tries to cut China out of dollar markets, it doesn't just hurt Chinese banks. It creates default risk for bondholders globally, including American pension funds, European insurance companies, and Middle Eastern sovereign wealth funds. China is building financial interdependence as a shield against financial warfare, and it's doing it using the tools of capitalism in a way that's difficult to counter without abandoning the principles of open capital markets the U.S. claims to defend. Now here's where Russia fits into this. Moscow cannot replicate China's strategy. Its economy is too small. Its financial institutions are too isolated. But Russia benefits indirectly from what China is doing. Every move China makes to build redundancy in dollar access creates precedent and infrastructure that other countries can study and potentially use. If Chinese banks can operate dollar balance sheets through offshore vehicles that are difficult to sanction, that's a model. Other countries will examine it. Some will attempt to replicate elements of it. The more fragmented dollar access becomes, the more it runs through offshore centers, non-U.S. subsidiaries, and complex structured vehicles, the harder it is for Washington to control. And the harder it is to control, the less effective dollar dominance is as a geopolitical tool. Russia is too far gone to benefit directly. But the erosion of U.S. financial leverage that China is engineering creates space for other actors to maneuver in ways that would have been impossible 5 years ago. And then there's the Saudi calculation. The kingdom holds more than $400 billion in foreign exchange reserves. It prices its oil in dollars. It has a currency pegged to the dollar. Its entire modern economy was built on the assumption of a stable dollar relationship with the United States. But Saudi Arabia is also in active discussions with China about pricing some oil sales in yuan. It's joining BRICS economic forums, and it's watching very carefully as China demonstrates that you can maintain dollar exposure while building insulation against dollar coercion. If Saudi Arabia ever decides it needs that kind of insurance, the infrastructure China is building offers a template. And the day Saudi oil trades in significant volume outside dollar settlement is the day the petrodollar system, one of the foundations of post-1971 dollar dominance, begins to fracture. That's not happening tomorrow. But the conditions that make it possible are being constructed right now. And the construction site is offshore dollar markets most Americans have never heard of. Here's the part that connects to your life. Why does this abstraction about offshore banking and dollar bonds matter to someone filling up a gas tank in Ohio or paying a mortgage in Texas? Because the dollar's role as the global reserve currency is what allows the United States to run trillion-dollar deficits without immediate inflation consequences. It's what keeps Treasury bond yields low enough that the federal government can service $34 trillion in debt without dedicating 30% of the budget to interest payments. And it's what maintains the purchasing power that lets Americans buy imported goods at prices other countries can't access. That privilege is not a law of nature. It's a function of structural demand for dollars. And structural demand depends on the absence of viable alternatives or workarounds. If dollar demand softens, if countries find ways to do international business that require fewer dollars, or if they build financial structures that let them hold dollars without being vulnerable to U.S. policy decisions, then the privilege erodes. When the privilege erodes, interest rates rise. The cost of servicing government debt rises. The value of the dollar relative to other currencies falls. And the price of everything Americans import, which is a lot, goes up. That's not a next month problem. It's a next decade problem. But the foundation is being laid now, and most Americans have no idea it's happening because the language of offshore finance is deliberately opaque and the implications are not immediate enough to generate headlines. What burned into the architecture of global finance over the last 8 months is not a collapse. It's a structural shift. China is not attacking the dollar. It's insulating itself from dollar coercion. And in doing so, it's demonstrating to every other country with significant dollar exposure that such insulation is possible. That changes the strategic calculation for dozens of nations, and it changes the boundaries of American power in ways that won't be fully visible until the next crisis, when Washington reaches for the financial weapon and discovers the weapon no longer fires the way it used to. Here are 3 predictions with clocks attached. First, within 14 months, the U.S. Treasury Department introduces new sanctions authorities specifically targeting offshore dollar intermediation by state-owned banks from strategic competitor nations. It will be framed as national security protection. It will be a response to what's happening right now. Second, within 2 years, at least one major emerging market economy publicly announces a policy to hold a significant portion of foreign reserves in dollar assets managed through non-U.S. financial institutions. It will cite risk diversification. The real reason will be sanctions insurance. Third, within 36 months, we see the first major test case, a geopolitical crisis where the United States attempts financial isolation of a major economy and discovers the tools don't work as effectively as they did against Russia. The target will likely be a Southeast Asian nation caught between U.S. and Chinese spheres, and the outcome will force a public reckoning about the limits of dollar weaponization. Drop your prediction in the comments. What happens first, Treasury's new sanctions authority, another country following China's model, or the test case where dollar coercion fails? Tell me, because I read every single one. If this gave you a framework for understanding financial maneuvers the mainstream press describes but doesn't explain, share this with one person who needs to see it, someone who thinks the dollar's dominance is permanent and unassailable. Show them the math. Show them the strategy. Let them decide what it means. The next video goes somewhere even this one didn't reach. The intersection of central bank digital currencies and the offshore dollar system. What happens when China launches a digital yuan that can settle cross-border transactions in real time without correspondent banks? Subscribe so you're there when it lands.